Good evening, everyone. Welcome to the episode 5 of Filtered Coffee with Quantace. As we step into the vibrant month of May, the buzz is not just about the rising temperatures, but also about the heated dynamics in the Indian stock market. Today, we are set to explore a trio of intriguing topics that are shaping today's narratives. In this episode, we dwell deep into the currents shaping our markets, heavily influenced by the ongoing Lok Sabha elections. They are a catalyst for substantial market movements as investors across the spectrum, from retail to big players like foreign institutional investors, closely monitor the potential outcomes and their implications on future market trends. We'll start by examining the robust activities of the FIIs, who are notably shaping market sentiment through significant capital movements. Their recent actions reveal their sentiment in the market's prospects. Understanding the motivations and impacts of these movements help us gauge the market's pulse during these politically charged times. From there, we'll transition to discussing how market sentiment is particularly vulnerable to rumors and news, illustrated by recent flurry caused by speculations around capital gains reforms. This segment will highlight the swift and sometimes harsh reactions of the market to unconfirmed reports. And finally, no discussion about market dynamics would be complete without a look at the indicators of volatility. The India VIX has seen a notable rise triggered by elections. Will break down what this increased volatility means for your investments and how history can offer us clues about what might happen once the dust settles post elections. As we navigate through these topics, our goal is to equip you with a clearer understanding of how major events like elections impact financial markets. So settle in with your favorite cup of coffee as we brew some fresh insights into today's most pressing market topics. Let's kick off our today's discussion by zooming in on the activities of foreign institutional investors, whose movements often serve as a barometer for broader market sentiment. In the lead up to the Lok Sabha elections, we have observed a significant trend. FIIs have rolled over long positions amounting to a substantial 24,200 crore to the May expiry. It's a strong signal of their confidence in the Indian market. Such a bullish stance is typically driven by a blend of factors, including positive expectations from elections. What's interesting here is the timing. The elections are viewed not just as a political event but as a pivot point for policy direction, which can have lasting impact on investment climates. FIs, with their finger on the pulse of both global and domestic economic cues, appear to be betting on a favorable market environment post-elections. However, the market is not immune to shocks. Last Friday, a ripple was set through the markets following a report by a leading business news channel. The report speculated on potential changes to the capital gains taxes, aiming for uniformity across different investment instruments. This led to a swift reaction from FIs, who offloaded stocks worth 8,200 crores. This sell-off is a textbook example of how sensitive the market is to rumors and news. FIs holding substantial market influence can trigger significant price movements with their buy or sell decisions, which in turn impacts overall market sentiment. The takeaway from these developments is twofold. First, the importance of understanding the underlying factors driving FIIs activities, as these can provide early signals about market trends. And second, the impact of information, accurate or otherwise, on market stability and investor behavior. As market participants, developing a strategy to manage information flow and react judiciously to market movements is key to maintaining a steady investment approach. As we move forward in our discussion, let's pivot to a key parameter of market sentiment, the India VIX. Over the past week, there's been a significant 27% spike in India VIX, and understanding this helps you know what this means for your investments. For those unfamiliar, India VIX measures the market's expectation of volatility over the coming 30 days, derived from the bid and ask prices of Nifty index options. A rise in India VIX suggests that traders expect higher volatility, and typically it serves as a fear gauge that indicates how risky market participants perceive the environment to be. This notable increase in India VIX is primarily driven by the anticipation surrounding the ongoing Lok Sabha elections. Such events are pivotal as they can redefine market and economic landscapes, prompting investors and traders to brace for potential swings. Elections play a critical role in shaping economic policies and thus market confidence. The uncertainty about the election outcomes and subsequent policy directions tend to heighten market nervousness, which is directly reflected in the rise of India VIX. It's not just about who wins or loses, but how stable or volatile policy making will be in the future. Look at historical data. You'll find that while the VIX tends to surge around major events like elections, economic announcements, or significant corporate earnings report, it generally normalizes following these events. This pattern suggests that much of the heightened volatility is indeed a temporary response to anticipated risks rather than a long-term shift in market dynamics. What does this mean for investors? Essentially, while short-term marketplace might be risky during high VIX periods, but the fact that it normalizes post-event could present opportunities for those with a longer-term perspective. Savvy investors who watch the VIX closely should also be prepared to look beyond the immediate turmoil as the market digests the outcomes of elections and adapts to new policies. Those who keep a cool head and a clear strategy can navigate through volatility more effectively. Continuing our exploration of the markets, let's dive into the sectors and market cap preferences that are shaping our investment strategies today. In the current market landscape, several sectors are emerging as front runners, potentially offering significant opportunities for outperformance. These includes finance, non-banks, realty, mobility, consumer durables, and information technology. Each of these sectors has its unique drivers and market positioning, making them attractive in the current environment. Complementing our sector focus is a strategic preference for investments across the spectrum of market caps, starting with micro caps and extending through to large caps. Our quantitative analysis has pinpointed the 22,000 to 22,100 as a critical support level for Nifty. The maintenance of this level is vital for sustaining market confidence. A breach here could signal a significant shift in market trajectory, prompting a reassessment of current strategies and potentially indicating broader market adjustments. While we navigate through these fluctuations and sector-specific dynamics, it's important to maintain our long-term perspective. Despite the short-term volatility often triggered by events like elections or policy changes, the overarching growth of India's economy remains robust. This suggests that it will be better to focus on structural strengths rather than getting worried by short-term disturbances. In short, look beyond the immediate market reactions and consider the long-term economic fundamentals. Thank you for joining me in this deep dive today. Make sure to tune in to the next time as we continue to explore more aspects of markets. Don't forget to like, share, and subscribe. Also, share your thoughts in the comments below. Until next time, keep investing smartly and stay grounded in your long term goals.